And I could just imagine what must have been going through their heads. Because like those Civil War speculators, they were trying to figure out what the outcome of this crisis was going to be. And if I had been a hedge fund manager sitting in the audience on one of these days, and I thought the euro was going to survive, then what I would have done with the probably $10 billion at my disposal is I would have gone out and bought Italian bonds. Italian bonds on that day were trading at, they were returning 7% interest. 7%. U.S. Treasuries at the time were returning 1%. So if you made this investment and you guessed right, the participants in your fund and you would be handsomely rewarded. On the other hand, if you concluded that the euro is going down and you happen to own some of those Italian bonds, you'd dump them as fast as you could. So, one of the reasons I call this talk about the past, present, and future, because everything in money is forward-looking. It has a history, but everybody's looking forward because it's all about the confidence in the dollar. Now, fast forward a little bit from the Civil War to 1913. Why 1913? Because we historians are enamored of dates? No. Historians, and none of you historians in the room, don't contradict me. We don't care about dates. Dates are only important as a way of keeping things in order. And I don't know if you have this experience, but sometimes I don't even tell people I'm a historian. I don't tell people I'm writing about history. I write books of, well, they're history, but often they're disguised as biographies. And the reason I disguise them is, if I tell somebody I'm writing a history, I don't have to say much more than that word history, then the eyes start to glaze over. And the listeners remember that history course that they had in high school, and I really hope I'm not offending anybody here, but they can't remember what the last name of their high school history teacher was, but they're pretty sure that the first name was Coach. And they remember that they had to memorize these dates. And that's why they hate history. 1913 is important because that's when the Federal Reserve was created. And what did the Federal Reserve do? It put the United States government in the business of managing the dollar, managing a flexible currency. Who is the head of the Federal Reserve today? Ben Bernanke. Ben Bernanke might well be the most powerful person in the United States today. You might think it's President Obama, and in certain areas it is. But who's going to determine what you're going to pay for a car loan? It's not the President of the United States. Who's going to determine what you're going to pay for a mortgage loan? It's not the President of the United States. Who is going to have a larger role in determining whether the economy gets better or worse? It's less the President of the United States than the head of the Federal Reserve. Why is this? Because the Fed chairman is the one who oversees monetary policy. Are dollars readily available, or are dollars stingily available? From 1913 until the present, the United States has had a managed money supply. For the first 20 years of that period, the United States remained on the gold standard, but amid the Great Depression of the 1930s, the U.S. government went off the gold standard, at least for domestic purposes. Why? And this gets back at the criticism of Ron Paul and people who think we ought to go on a gold standard. The problem with a gold standard is that the connection of the gold supply to the economy as a whole is simply accidental. It's an accident of geology. It's an accident of chemistry. Is the gold supply increasing, expanding at the same rate that the economy is expanding? If so, then prices will be stable. And in fact, that's the goal of nearly any monetary policy, to get prices roughly stable, maybe with a little bit of inflation built in, and there are reasons for that we could discuss. But if the gold supply is shrinking relative to the economy as a whole, then you get deflation. Prices are falling. Is this a good thing or a bad thing? Falling prices? Well, you might think as a consumer, that's great. But what would you think as a producer? You'd think, that's terrible. If you're a farmer and last year you got $1 for a bushel of wheat, and now you get 50 cents for a bushel of wheat? That's a terrible thing. You can't make ends meet. That's exactly what was happening during the Great Depression. It's one of the reasons they called it a depression. And that's why the U.S. government went off the gold standard. Because gold is this thing that cannot be controlled. But that is exactly its merits in the idea of those people who want a gold standard. Why? Because they say, those politicians, they can't keep their fingers off the controls. And they'll just expand the money supply and expand the money supply until the dollar's not worth much of anything at all. Yeah, there is that problem, which is why there's a Federal Reserve System. The chairman of the Federal Reserve, the other members of the Federal Reserve Board, are not politicians. And they can't be fired by the president. And it's going to end pretty soon. Okay, Branch, you're a historian. You're maybe on firm ground when you look backwards. So how can you say this is confidently looking forward? This is where history comes into play. The United States dollar became the linchpin of the whole world economic system in 1944, at the end, near the end of World War II, when the world's major economic powers got together and they wrote the rules of the road for international finance going forward. The system was created at a New England resort called Bretton Woods. It was called the Bretton Woods system. And the essence of the Bretton Woods system was that the dollar, Andrew Jackson there and his buddy Benjamin Franklin, held the world on their shoulders. All the major currencies of the world were pegged at fixed rates to the dollar, and the dollar was pegged at a fixed rate to gold. So, as long as the dollar was strong enough to hold the world's economy on its shoulders, then this system would work. But that system was bound to erode. Why? In 1945, let's pick the end of World War II, the United States economy produced half of the world's industrial GDP. To put it another way, America's mines, mills, factories produced as much as the rest of the world combined. Under those circumstances, the currency of that economy, the dollar, was the natural one to rest the rest of the world's financial system on. Today, the U.S. produces less than 1/5 of world GDP. Under these circumstances, there's no way this single currency can form the basis for the world's economy. Does this mean that the American economy is weakening? No, not absolutely. The standard of living of Americans today is far higher than it was in 1945. There are all sorts of things that we take for granted that would have been considered, I don't know, magic in 1945. Start with a cell phone. If you could have had a cell phone in 1945, it would have, well, you couldn't because it didn't exist. And now we take them for granted. Televisions, airplane travel, all that stuff. We live far, far better in a material perspective. We'll leave aside the moral aspects. I mean, you have your own feelings about that. But materially, we are far, far better off than people who lived 65 years ago. But comparatively speaking, compared to the rest of the world has caught up. And the rest of the world is going to continue to catch up. After all, there are 300 million Americans, and there are 7 billion people in the whole world. So to think that the currency of the United States is going to sustain the rest of the world's economy is simply a pipe dream going forward. Now, you might well object and say, yeah, but what currency is going to replace the dollar? Is it going to be the euro? Some people thought about this. After all, the GDP of the European Union is bigger than the GDP of the United States, but look at the trouble the euro's having. No, in fact, the answer to my question is which currency is going to replace the dollar is no single currency. There will be perhaps a hybrid currency that is based on, say, a market basket of a bunch of different currencies. It may simply be that the big investors around the world, like the Chinese Sovereign Wealth Fund, will invest in other currencies at the same time that they invest in dollars. So the American position is going to continue to erode over time. Americans are going to lose some of the advantages of having the world's reserve currency. And the first thing that's going to happen is we're going to pay more for everything that we have to buy. Because everything has interest rates built into it. And as people decide that they're not going to give money to the U.S. Treasury almost for free, that in fact the U.S. Treasury is going to have to bid competitively with other possible sources of investment, then interest rates are going to rise. And everything else is going to rise too. And we're going to look back on the period of the American dollar as this moment when Americans got almost a free ride on the world economy. Okay, that's enough provocation for tonight. I'll stop. I invite questions, objections, rejoinders, please. Anybody?